the number of active accounts in Stacks has reached a record level. The leading second-layer Bitcoin network, Stacks, has reached a record high in the number of active users, driven by growing interest in Bitcoin-based decentralized finance, DeFi. In April, the Stacks network, STX, reached a new record high of 122,497 active accounts. Active accounts are addresses that have performed at least one transaction, according to a May 2 report from Bitcoin data provider Signal 21. The record number of accounts suggests growing interest in Bitcoin DeFi, or BTC-Fi, and occurred a week after the 2024 halving event and the launch of Runes, a new protocol for issuing fungible tokens on the Bitcoin network. According to Andre Serrano, a product and partnership manager at Stacks, Bitcoin Runes and Ordinals could increase activity on Bitcoin's second-layer networks, as rising fees on the Bitcoin network will push smaller transactions to L2. Serrano told Cointelegraph in an interview. In the Bitcoin L1 network, a lot of assets will be issued, which will lead to increased transaction fees. This will result in losses for a large number of users. Ultimately, transferring most of this activity to L2 will become a necessity, said Serrano. According to CryptoQuant, on May 1st, the average transaction fee for Bitcoin fell to $1.72 compared to the historical high of more than $92 reached on April 20th, due to the halving of Bitcoin rewards. Bitcoin L2s, such as Stacks, are a crucial element of BTC-Fi, allowing for reduced transaction costs and expanded capabilities of the world's first blockchain network. For instance, the second-layer network Stacks enables the creation of smart contracts for the Bitcoin network. Serrano from Stacks explained that L2s are even more important for Bitcoin than for Ethereum, which already has built-in smart contract capabilities. He added that L2 levels are necessary to scale the Bitcoin network beyond its current transactional limits. The prospects for the development of Bitcoin DeFi or BTC-Fi are generating widespread enthusiasm in the crypto space. According to Nash Lee, co-founder of Merlin Swap, with the current development of BTC-Fi, it could significantly grow and match Ethereum's DeFi in terms of innovation. 100 Finance hacker moves stolen assets worth $7 million a year after exploit. A hacker who stole $7.4 million from the decentralized finance, DeFi, protocol 100 Finance has begun moving crypto assets after a year of inactivity. On May 1st, the hacker transferred approximately $800,000 worth of Ether in Tether from the decentralized exchange Curve after providing liquidity on the platform over a year ago. After withdrawing the funds, the hacker converted USDT and other cryptocurrencies to ETH. This increased the exploiter's ETH holdings by more than $1 million. Currently, the hacker holds assets worth a total of $4.3 million in their wallet, including various crypto assets such as DAI, FRAX, Wrapped Ether, WETH, and Wrapped Bitcoin, WBTC. On April 15, 2023, the second-layer DeFi network Optimism reported a loss of $7 million due to a hack. It was reported that the attack exploited a security flaw that allowed the manipulation of token prices using flash loans. According to blockchain security firm CertiK, the perpetrator manipulated the exchange rate of ERC20 and H tokens. This allowed them to withdraw more tokens than were deposited. In the DeFi world, this is widely known as a flash loan attack. This type of attack vector typically involves borrowing large sums of money using some form of uncollateralized credit on a lending platform. The perpetrator then uses the assets to manipulate cryptocurrency prices on DeFi platforms. During the 100 Finance hack, large loans were taken at a falsified rate. In 2022, 100 Finance also suffered an attack on the Gnosis (GNO) network. The protocol's liquidity was drained as a result of a reentrancy attack, leading to losses of $6 million. A similar attack was conducted on another DeFi protocol called Agave at the time. Although flash loan attacks have wreaked havoc in the sector over the past few years, April 2024 saw a significant reduction in losses from such hacks. According to a CertiK report, only $129,000 was lost due to flash loan attacks in April. The largest incident of the month caused damage of just $55,000. The CertiK report states that this is the lowest amount lost due to flash loan attacks since February 2022. Meanwhile, losses from cryptocurrency hacks in general also decreased in April. Security company PeckShield reported that only $60 million was lost due to hacking attacks over the month. This represents a sharp decline compared to February and March, when losses were recorded at $360 million and $187 million, respectively. JP Morgan identifies 3 factors clouding the future of the cryptocurrency market. Analysts at banking giant JP Morgan maintain a cautious stance regarding the cryptocurrency market. Experts have identified 3 main risk factors that cast a shadow over the near future of the sector. This cautious viewpoint from JP Morgan serves as crucial guidance for investors navigating the volatile cryptocurrency markets. Nikolaos Panagurtsoglou, head of the analytics department at JP Morgan, explained why he holds a rather conservative forecast. His concerns are driven by 3 risk factors: the high price of Bitcoin relative to the cost of gold and the estimated price of mining the asset, a decline in interest in the primary cryptocurrency from retail investors, a reduction in startup funding. Due to the lack of positive catalysts and weakening momentum from retail investors, we maintain a cautious position regarding cryptocurrency markets in the near term, write JP Morgan analysts. In April, Bitcoin fell by 16%. This was the largest monthly decline in BTC value since June 2022. The negative trend coincided with low interest from retail investors, who are currently not enthusiastic about cryptocurrencies and stock markets. The declining interest is also evidenced by ongoing outflows from spot Bitcoin exchange-traded funds in the United States. On May 1, a total of $563.7 million flowed out of the instrument, marking the highest outflow since the launch of the funds in the American market. Meanwhile, no capital was injected into the iShares Bitcoin Trust, IBIT, by BlackRock over the last week. Instead of inflows, the world's largest asset manager recorded a negative dynamic. The change in market sentiment can be partly linked to profit-taking. In the last 2 weeks, according to JP Morgan analysts, institutional investors have sharply reduced previously bullish positions on Bitcoin and gold. Experienced players are more actively reassessing the risks of their investments, possibly anticipating further volatility. In August 2023, JP Morgan analysts noted an increase in trading activity in Bitcoin futures. At that time, they interpreted such dynamics as a sign of market stabilization and allowed for the possibility that cryptocurrency market prices would finally recover. The market indeed experienced a sharp turnaround. Initially, this was facilitated by interest in spot ETFs on BTC, and then by anticipation of the Bitcoin halving. Against the backdrop of positive forecasts about the price of the asset after the long-awaited event in March 2024, the main cryptocurrency established a new all-time high. However, the recent setback has prompted JP Morgan experts to revise the market's trajectory.